Hi, everyone. Thanks for joining our monthly discussion. I'm David Sokolovsky. We have Vanessa Martinez and J.R. Gondek with us this time. Wanted to talk a little bit about some of the things that we're seeing in the economy recently, some of the challenges ahead and some of the potential opportunities. We're also going to dive into an example and a case of what we're seeing in the market, as well as bringing on Wayne Cooper, who's our wealth strategist, to talk about some estate planning options. And obviously, we wish we could have done this one in person, but it looks like we have another month or so to go before we can get back together. So with that, GR, maybe do you want to briefly talk about some of the things that you're seeing and some of the developments in the market since the last time we met?
Yeah, we see this tug of war unfolding as the economy starts to slowly reopen across the board. And the tug of war is going to be in many different areas. Specifically, if we think about employment, terribly more than 30 million people have lost their jobs during this horrific period. But the worst seems to be over. I mean, the peak was probably, if we had to guess, last week as far as unemployment claims. And as you look forward, we see this tug of war we're talking about, where you're going to have more troubled industries and still some job losses ahead versus the restart. As economies are restarting, those jobs can come back very quickly. For example, Georgia last week, as they restarted, added 76,000 jobs in 1 week. And that, as you see the expansion throughout the economy, you could see how those jobs could really come back fast.
Yeah, just taking Georgia for example, and we can use that as a multiplier effect, right? There's many things that I feel we can look at to kind of track or at least try to see or foresee what the future will look like. David, if you can pull up a quick chart that we made here on TSA travel. So you can see on here that from March 1st to the March 31st, you see the gray line's 2019 numbers and the gold line is 2020. So daily travel declined by 94% from the high. Then you look on the box to the right and you can see this increase of 159% from the low. So back in 2019, numbers ranged between 2 million to 2.5 million traveling daily. So that's an extreme difference between what it is now, but we can see the progression between April 1st being in the low 100,000 people per day and where it is now up to 250,000 people traveling.
Well, let me ask you guys a question. So as we think about this, do you think it's riskier, what's your personal opinion, to go into a restaurant as they reopen or to get on an airplane and fly?
I'd have to go with airplane.
I think I agree with David.
And I think that's probably pretty reasonable if you polled most people. So as you think about the TSA checkpoint numbers likely continuing to trend up, you could see that as a very good leading indicator. It's posted every morning at 8 o'clock, 9 o'clock Eastern time from the prior day. And the more people that are traveling, you know, if you're that comfortable getting an airplane, likely that many more people that are going to go into restaurants. And if you think about the travel numbers continuing to pick up, that's more hotel rooms, that's more taxi cab rides, that's just more business going on. And it's a daily figure that should be good to see as it picks up for the airlines potentially and other recreational items throughout the country. So we think that's a creative leading indicator that we're following to get read through and multipliers, but as I said, throughout many other potential industries.
Yeah, and Jared, that's a great point because we've seen that consumer confidence has come down in recent, weeks and months, obviously as a result of what we're seeing with portions of the economy being shut down. But as we see different venues start opening up, obviously air travel picking up and different states taking a phased approach to a reopening, that consumer confidence can come back relatively quickly, especially as folks are less concerned about the prospects for their employment. I think another thing that's worth mentioning is we've seen that consumer income has remained steady We haven't seen the latest numbers come out through the month of April, but through March, the income has continued to increase. But we have seen a drop off in spending. So as cash reserves build up for the consumer and creates this pent up demand, it'll be interesting to see how that plays out as consumer confidence starts picking up and that money is starting to be put back to work in the market.
Yeah, we think, David, it's a good data point on savings rate, as David said, is about 10% now, whereas prior to the savings rates were about 7 or 8%. So as things reopen, the consumer overall is in very good position, despite the fact with the 30 million people that have lost their jobs are getting unemployment, but the overwhelming majority, they're still working. Most of us have been unable to spend. So the consumer, as things restart, are in a very good position overall.
Jared, can you maybe quickly also talk about, with regards to real estate, some of the things that we're seeing, and maybe this is another thing that has some confidence in the market, with the number of folks who are starting to catch up on their mortgages?
Yeah, the data point, this was concerning a month or so ago. As the crisis hit, a lot of stories were written, and there was a perception that many people could skip payments and kind of go into forbearance for a period of time, and the banks would allow you to skip 3 or 4 months payment. So the peak number we saw was about 6% of mortgages went into forbearance. And it caused a lot of people concern looking forward that you could get another real estate or financial crisis like we saw in 2008, where that increased dramatically. The good news is that there's other data points this time that have improved. People are starting to repay those or pick up, and forbearance has gone down in recent weeks, which is a very good sign that the consumer savings numbers and the overwhelming people still working are continuing to pay their loans, and it's a good sign looking forward. And then when you look at other data points for now that are different from 2008 and 9, is people have a lot of equity in their homes still. You're not seeing the foreclosures. In 2008 and 9, your equity was gone. So there was less incentive to continue to make your mortgage payment because you had nothing left in equity in the house. And the other thing is, with interest rates as low as they are, people look at the cost of renting monthly versus the cost of owning. And at this point, with interest rates as low as they are, it's much cheaper monthly for people to own still. So it's a good sign. It was a potential negative a few weeks ago, but it's definitely picked up into a positive.
So, Jer, I agree with you when it comes to residential real estate, but what gets me a little worried is more so the commercial side. When I think of our business and the work from home that we're doing and how many people are going back to the office, I feel that there'll be a blend even in our business. I get it that when we're talking to clients or we're visiting them in their homes, it's a little different. But just thinking about all the industries that are out there, I feel overall as time progresses and people see a little bit of the value and the cost effectiveness of working from home, that the commercial real estate might get hurt in that area. And I understand that people have leases and they're long-term, so it's not like a switch that they can turn on and off, but there still will be some challenges on the commercial side of real estate.
Vanessa, the commercial real estate concern is top of mind. The Fed is concerned overall with that, as well as backstopping other items out there. David, can you pull up the Federal Reserve balance sheet, which we've highlighted many times in the past? When you look at this graph, you can see that the Federal Reserve balance sheet was fairly steady up until the crisis of the last couple of months. And the Fed has been very transparent that with the concerns Vanessa mentioned in commercial real estate, the restart risk of the virus coming back and such, the Fed will continue to expand this balance sheet till we get to a normalized economy across the board. So that should help to alleviate or have a softer landing on some of these. And if you look at this graph, it breaks out the increase of what the Fed is buying as they're expanding the balance sheet. The gold are the treasuries, which the Fed has continued to do since the financial crisis. But the newer items are some of the newer programs. They've increased the agency and mortgage back to help with the commercial real estate, as well as the other has gone up dramatically. You see a huge percentage increase, almost 3,000% on the graph because it started from such a low level under the other category in February. And these are some of the newer programs to expand in small business lending and other areas, corporate bond and municipal bond purchases. And you're going to see all these programs increase to help alleviate some of the concerns that are out there. And when you think about all this money printing, inflation is a likely concern that clients have asked us about and other items ahead. David, do you want to talk a little bit about maybe the oil aspect of what's happened and maybe some concern?
Yeah, so with regards to inflation, obviously it can come in many different ways, but one of the things that we're seeing is particularly with oil and energy. So we've seen that, last month, I think when we spoke, oil had just gone negative for the first time in history. And so since then it's rebounded, significantly, ending the day today above $30. So if you think about that swing from just a month ago from negative 30 to positive 30, that's just a huge, absolute change. But one of the things that we look at is the Baker Hughes rig count. And so that's essentially looking at the oil rigs that are in operation producing crude oil. And so you can see that, this number has been pretty steady leading up to, the crisis, but really starting at the end of March and through the month of April, you can see the reduction of these facilities. So 59% or roughly 60% of these facilities have been taken offline. So from about 625 to about 250. And what that's going to mean is, as there's more demand and as demand can snap back just as quickly as we saw the demand evaporated, it will create an inflationary, or could potentially create an inflationary scenario where the capacity is going to take some time to come back online. And before it's available, the demand from either, global travel, which might be picking up, or manufacturing, which might be picking up to obviously increase some of the prices. And we're seeing a little bit of that coming out of China with some of their production levels and some of their demand that's coming back to pre-crisis levels. So if we continue to see that across the board, inflation could definitely become a concern.
As you look at the Fed concern of many people on inflation, to David's point, is we expect as you look ahead to see some of these inflation shocks and huge increases, where the example of oil demand coming back in China to pre-crisis levels. But if you look at the supply shut off in the United States over the last 6 weeks, as demand picks up this weekend, for example, with Memorial Day, you could see that huge spike in prices. Talk about airline tickets. Many people talked about $20 flights over the last 8 weeks when the demand, the TSA numbers Vanessa went over earlier. Now, as you look at flights, prices have shot back up dramatically because the airlines cut capacity. So what we expect a little bit is with the supply down in a lot of industries, and specifically in commodities, as you see an increase of demand overall with that supply down, you could see these humongous spikes of commodity prices ahead, and we expect that.
So Jared, with all this kind of volatility and obviously seeing, the potential, we saw the good and some of the opportunities that are coming up, but also some of the, potential pitfalls, whether it's, inflation or the commercial real estate market. What are some of the conversations that you're having with clients and what are they thinking?
If you look at Warren Buffett, being a legendary investor, continues to make some headlines recently of the amount of cash he's holding. And specifically this past week, it came out that he raised more cash selling some of the banks. And a question that's come up a lot is, if Warren Buffett is raising cash, how come? Should we be a little more concerned? And I think when you look at the opportunity of that, in general, what Warren Buffett says, you should buy the S&P index because he's going to have a very difficult time outperforming because he's so large. When you look at the opportunity with that, of what he's saying is he used to be able to buy smaller companies, but now that he's so large, he's unable to buy little companies because if he does, he'll own the entire company. So if you look at an opportunity we continue to see out there are the difference between the performance of small cap companies versus the larger companies. And there continues to be a huge underperformance of small cap companies, which is very critical to look at stock selection, kind of the value criteria Warren Buffett has done over the years. So despite the fact that he's raising a lot of cash, a lot of that is he doesn't see the opportunity, and he can't buy some of the small companies because of the fact that he's so large. So many of those we've talked about in the past few weeks, but you continue to see very good value in select industries and select companies that should produce very good returns over the near and longer term.
I agree. These opportunities that are out there, being active investors that we are, I feel gives us that edge where I think typically clients see advisors, and you see it on the news, you see it in the newspaper, oh, your advisor is telling you to hold on and we'll get through this. But I feel that's a big differentiator for us. If David, you can pull up the volatility index chart that we have. You can see here, so the volatility index, also known as the fear index, right? We can see in the gray is the S&P and the gold is the VIX. And in past times, you could see how they just flow together. You could see that on March 16th, the VIX was at an 83, which is very high. And around that same time was when the S&P reached its bottom on March 23rd. Now, if you're looking in today's time, you can see how they're slowly intertwining and the VIX is now lower, right? So that's saying that its index is reporting that fear has gone down. But as we're in talking to clients, the fear is still there. Right? Everyone's concerned of this uncertainty of what's to come. When we talk about the commercial real estate, when we talk about consumer confidence, this is real fear and people still have it. So we still get these calls of, is now the time? Should I just sell? I can't take it anymore. I don't know what to do. No one knows what's going to happen. So there's many aspects, and it's different for each family to say when to move and when not to move. But I feel if we can all have that feeling of we are actively investing. So if on a day, let's say on Monday, our team overall, our investment team decides that we should sell some to raise some cash, right, and take advantage of other opportunities, that's our strategy. But then if we have clients call in and tell us, oh, you know what, it's just, I can't take it anymore, we need to sell. And we're already selling. So this is where we feel that what's compounding is this overreaction, right? So overcorrecting. So we're trying to correct, but then the fear is imposing that emotional investing that's happening where clients are calling in to tell us that. So obviously nothing can give that full, peace of mind, but know that we are constantly watching and taking action. We're not telling you to just hold on and that, magically things will get better. We're definitely looking for opportunities, as JR mentioned, in small cap. We're definitely looking at when we should raise cash and get back in. But these are just aspects that I feel overall, it's very difficult to overcome. Once you've sold, to get back in, it makes it very difficult to do it. But know that we're definitely watching and taking action. And there is a plan for each family.
Yeah. Vanessa, looking at that graph. Oh, go ahead.
It's a very good point, Vanessa, on kind of strategy, because as we wrote in the monthly letter and then other points out there, is these are difficult times. There's no question. And despite the fact that things feel better than 2 months ago, there's a lot of pain out there. And our thinking is still to hold overall in portfolios a larger than normal amount of cash to do a lot of what Vanessa said. Either put your mind at ease a little bit, but still be mindful of all the opportunities that are still out there. Mm-hmm. That's a very good point.
So Vanessa, from a client's point of view, what would be a good example of a time where we're raising cash beyond what we're doing in the portfolio might be prudent?
So there's different things that can happen in a family's life that would require that. So there could be a business problem, right? So if I'm dependent on my portfolio and let's say I do own a restaurant and that's had to be shut down, so I do need additional income or I do need some cash flow. In those cases is where I completely understand someone calling and saying, hey, Vanessa, I really need you to raise some cash or additional cash because I need this portion. I never want anyone to feel, because it's definitely your money, right? I never want anyone to feel that I'm trying to stop that. I feel that we're here to help guide and be that kind of emotional support, that in those times when someone wants to be frantic and it's not necessarily a need to have the cash, but the sadness of watching your portfolio decrease, I get that. But that's where we're here to help. That's where we're here to say, okay, let's take a deep breath. We understand, and this is what we're doing. This is the plan, and this is the goal. But definitely, if there's a life situation, especially with what's happening now, right? You have someone in the hospital, or this is happening, and you need that extra cash flow. Definitely, those are the times to give us a quick call, and we'd more than gladly quickly be able to get this done for you.
All right, so we've had an opportunity to talk about the economy, some of the challenges that we're seeing and opportunities in the marketplace, as well as diving into a couple of examples. And so now we wanted to introduce Wayne Cooper. He's our wealth strategist. And Wayne, can you talk a little bit about the estate planning topics and some of the opportunities you're seeing as it comes out of the CARES Act that's recently been passed?
Sure. So the most recent development is that the SBA recently released the PPP loan forgiveness application. So anybody who took advantage of the PPP loan availability and was able to get a loan can now apply to have that loan forgiven. Therefore, you would not have to repay the loan. Eligibility for that loan forgiveness is based upon maintaining your employee headcount from pre-loan to post-loan periods, and also using the proceeds of that loan for allowable costs. Not only can you only be forgiven for allowable costs, the amount that's forgiven will be prorated down if you spend less than 75% of the proceeds on employee-related costs. So even though rent, for example, is an allowable cost, if it takes up more than 25% of the loan proceeds, it would reduce the amount you'd be eligible for forgiveness. It's a complicated application. I recommend that you start working on it sooner rather than later. It doesn't have to be filed until the end of October. However, the sooner you get it in and start working on it, the better chance you'll avoid last-minute rushes.
Sure. So a couple months ago, we had a call and we talked a little bit about the details in the CARES Act. And one of the things specifically that I'd like you to talk about is that the RMDs for 2020 are not required. So what are the implications involved around that, or how can we help our clients?
Okay, a good point. A lot of our clients have decided to forego their required minimum distributions for 2020, which is allowed under the CARES Act. I just came across an example of a client who did stop taking his RMDs for 2020, and it made a significant effect on his estimated tax payment requirements for 2020. So if you are foregoing your RMDs, you may want to be certain to tell your tax preparer that when they compute your estimated tax payment requirements, they adjust for the fact that you may not have as much retirement income in 2020. Probably will not affect your Illinois computation because retirement distributions are not taxable in Illinois in any event, but it can make a significant change to your estimated tax payment requirements for federal purposes.
With interest rates, Wayne, at historically low levels, are there any planning opportunities around these low interest rates that you might consider?
I think there are. Interfamily loans really make a lot of sense when interest rates are low. We see clients all the time wanting to help with their children or other close relatives with the purchase of a home, either through the providing the mortgage or helping with the down payment. And we usually suggest that they make those in the form of a loan rather than taxable gifts. Those type of loans make a lot of sense right now because interest rates are so low. So the IRS recently posted interest rates for June. The short-term rate is only 0.18%, all-time low purposes. Midterm rate 0.43%, and the long-term rate 1.01%. So if you think your children might need a little cash flow or help with a house or otherwise, the interfamily loan makes a lot of sense. I would also say that if you've already made loans to your children and have outstanding notes or the like, maybe a good time to refinance them to give them the benefit of a lower interest rate.
Great. Well, Wayne, thanks for joining in. Obviously, to any of our clients and families that we work with, certainly feel free to reach out and we can address individual questions and also put you in touch with Wayne.
Great, thank you, and I'm happy to help. If anybody has any questions, please feel free to call me.
So thank you everyone for watching our thoughts, current thoughts of the market. We're just going to do a quick summary as we close up today. These are difficult times overall, and we feel like we've gone through the worst at this point of the economic drop-off, the job losses and such. And you're getting this feeling of optimism as we're slowly restarting everything. And as we look to the weeks ahead, we're going to monitor the changes, but I think a lot of our thoughts are mindful of what's going on, but then stay on top of these trends, whether it's looking at the TSA checkpoints and other items to help us figure out the leading indicators. And at times like this, Vanessa's commentary along the fear factor and the risk items that are out there, try to keep your emotions in check, because we've all taken this at different points, and the mental aspect of how difficult this has been on everyone. When you look at your investments, trying to keep a long-term plan in place and look at it, it has been very difficult on everyone, and we totally understand that. So we're here to listen and talk things through, but we continue to be cautiously optimistic, but are very much staying on top of this. And again, want to thank you for listening today and hope everyone stays safe.
Thank you.
Stay safe. We miss you.